So yeah, so it's okay. So for yeah, so share just a tab or a different window instead. Okay, so yeah, so what I was saying is like these two formula you are invariably going to use. You have used most of the times in uh, finding out the efficient frontier, in finding out the optimal portfolio. So the efficient portfolio proportion nothing but the matrix inverse of the variance covariance matrix, and multiplied you multiply this with ER minus C, where the ER is the expected return of your portfolio and C is the risk-free rate, or in the parlance of portfolio in the financial modeling of the finance, we call it that portfolio which has the covariance of zero with the market. So that's the first one. And the second one is we change that relationship a bit, and then we want to calculate the expected portfolio return, because if we are given the proportion and if you have the various covariance metrics, so what is the expected portfolio return? For example, if you take the Nifty 50 benchmark, and then you realize that okay, Infosys 7 HUL is 5%, TCS is 8, Reliance is 9%, and then so what is the expected portfolio return if you continue doing this? So you can calculate with the second formula, which is nothing but again the variance covariance matrix multiplied with the efficient portfolio proportion, which comes from the first, which is nothing but the Z matrix which you calculated, and then something which is most important for now is normalizing factor. So this normalizing factor is the important thing about which we want to solve it right now, and we want to proceed with. Though of course I did it at the last moment, but we will once again do it. And here we add the risk-free rate, because if you take this left, so risk-free rate will get added to the left-hand side of the relationship. So this is all about the two formula which we invariably use in our uh, calculation for expected return, benchmark proportions, or like the benchmark return and all that. So are you able to see the Excel sheet which I'm sharing now?
No, sir.
Okay. Okay. So I have to first stop and then again. So let's go to this. Can you see the can you see this uh, Excel sheet?
Yes, sir.
Yeah. So we were exactly here, but I once again want to start from here so that like you have the perspective before we move on to the next one. So we are into Black Letterman portfolio approach, where the anticipated benchmark return is 1%. Why? Because annualized return is 12%. So we have taken from 12, and this treasury bill return is 0.40. Why? Because 4.80 is the annualized treasury bill rate. So from there we are, because why we are doing this is because the variance covariance metrics is what that we are using is monthly. So if uh, uh, one of the factors in our calculation is monthly, so you cannot use any annualized things in our whole calculation, because the relationship will be lost. So if one of the factors is monthly, then everything has to be monthly. If one of them is weekly, then everything has to be weekly. So that's very important. So don't get into any problem in case you are using yearly data and you're somewhere using monthly data. So you just reconcile with the protocol of the calculation. Now, this like we are using this Black Letterman approach in case of portfolio, which is comprising of these 10, 5, 6, 7, 8, 9, and 10 stocks. We are doing this is a benchmark created by someone, maybe Morgan Stanley or S&P and someone. So these are the 10 stocks, which is General Motors, Home Depot, International Paper, Hewlett Packard, Altria, American Express, Alcoa, DuPont, Merck, and M3, 3M. Now the market cap is easily known because how market cap is known, every day the stocks are trading in the market, so they have a particular price. So for example, price is 100, and if there are only 100 shares listed, so 100 into 100, 10,000. So 10,000 becomes market cap. So here market cap is given because this is readily available on all the website everywhere, and even in the real-time basis on the stock exchanges website. From here we calculate the benchmark proportion, which is what is not available. So how do we calculate? So if we sum this all, if we sum this all, the sum is coming as 621. So 621 becomes market cap of our benchmark. So if I divide 16.85 by 625, I will get 2.71%. So this is how I calculate the proportion of General Motors in the benchmark. This is how I calculate proportion of Home Depot in the benchmark, because 73.98 divided by 621, which is a sum, then I will get the benchmark proportion. So I have calculated the benchmark, which is again very easy thing to do. And this various covariance metrics, as you know, is also that we have got used to calculating this. So we calculate various covariance metrics, which comes from their prices, their return, and then their average return, and then we do the matrix multiplication of the main matrix as well as the transpose, and then we get to that. So okay, so now how do we calculate this normalizing factor? So if you remember my Excel formula, so we'll once again do this. So in normalizing factor, there is something called ER minus C. So that is always the case. So what is the expected benchmark return? So that is 1%, which you know well. Okay. And then what is the constant rate here? Is this. So we have got this first part. Now we'll divide by this the proportion of the various covariance, then this benchmark proportion, variance covariance, and again the benchmark proportion. Now remember one thing, I'm giving you a trick that most of the time you guys might be facing a problem that which one to multiply with which one. Now in this case, as you can see, like the result is already on the left side. I'm just doing it once again so that you understand how it is done. So what happens is, because the normalizing factor will be one value, which will be 1, 1.2, 1.5, 1.9, 2, 3, 4, and 5. So it's going to be 1. In matrix multiplication, if you are going to have an answer which is just going to occupy one cell, then it has to be multiplication of 3 different matrices. One of them should be a normal matrix and the other should be the transpose of it. Otherwise, you won't get one factor, because if you multiply matrix M into N with N into P, you get matrix of the form M into P, and this continues. So the column of one matrix should be equal to the rows of the other matrix. Then only this multiplication is possible. So what happens? We write, having done this, so we do matrix multiplication. Okay, and because we are going to multiply 3 matrices, so what we need here exactly is 2 matrix multiplication, because if we write one matrix multiplication, it's not going to work. So the first matrix will be this row matrix of the benchmark proportion. So I have written this. Okay, and then I multiply this with this variance covariance. So I select the variance covariance. I've selected and I've closed the bracket. Okay, and then with this, I want to multiply the transpose so that it becomes, because this the first one is 1 into 10. The second matrix is 10 into 10. So 1 into 10 multiplied by 10 into 10 will give you 1 into 10. But we want 1 into 10. So 1 into 10, we'll have to multiply 10 into 10. So that's why we are going to do transpose of this original matrix, benchmark proportion. Now, if we do this, we'll get one cell answer, one value, not multiple value, not value in array. Now, another challenge for us, I mean, it's a little trouble for us, is to count how many brackets we are using. So if there are like 3 brackets on the left, so there should be 3 brackets on the right. So I think we just need one more bracket over here, and then I think we are done. So we'll use Control Shift and Enter, and then you've got the value of 2.12 which is exactly same as this value on the left side. So I just wanted you to be familiar with how to calculate this value. So because the digit is in some 7 or 8, so you are getting a longer number, but it's the same 2.12. Now, once you know the normalizing factor, the next challenge for you is to calculate the benchmark return. Why? Because the benchmark is 2.71 and the benchmark return is 1%. But what will the return of this these General Motors, Home Depot, and all that? So again, we'll use a formula. So what formula we'll use? So as you know, this for return we use what formula we used. If I can take you to that this hmm, uh, can you see? Okay, I will have to change that. But anyway, let me repeat this. So, expected portfolio return or expected benchmark return is nothing but a variance covariance matrix multiplied by efficient portfolio proportion into normalizing factor, and then there we add the risk-free rate of return. So that's how we do this. So let's go and solve that. Yeah. So again, we'll write metric. Sorry, I have to select all entire one. Otherwise, it's going to give me a false value. Yeah. So here I select the entire 10 cells for all the, and then what I do is I write the matrix multiplication because I'm going to multiply matrix. So what I have to first use is this variance covariance matrix because this was in our formula for the benchmark return. So I've used this. Okay. And then remember one thing. This is 10 into 10 matrix. If you multiply with 1 into 10, which is like this upper row, it's not going to give you any value because that will be this will give you a throwaway answer called value. Means like the Excel is unable to understand what you are doing because m into n should be should be multiplied with n into p, or x into y should be multiplied with y into z. Only then there will be sensible matrix multiplication. So we need not this row matrix, but we need a column of this, which is only possible if we make a transpose of this. So we make transpose, and then we do transpose of this, and then we close this bracket. Now, if you, some of you who are like remembering what to do, or like what was the formula, so remember this has to be multiplied with the normalizing factor, but you cannot multiply directly with the normalized. Why? Because first this matrix will get multiplied with this transpose, and then thereafter but before that we want this to be multiplied by this normalizing factor. So I'm putting one more extra bracket, and then using this normalizing factor as the multiplier, then again closing this, and plus here the risk-free rate, which is the treasury bill rate. So my formula for this benchmark return is done. Now I need to check whether I have omitted any bracket, or like whether I should be using. So 1, 2, 2, 3. So I think I 1, 2, 3, 3 on the right side. Okay, and 1, 2. No, so one more is missing on the left side, which is where let's try like if I use the command Control Shift and Enter. So there is a problem here. So if I remove this Wait, I think this bracket is sorry. If I do just like this, will I get my answer? Yes, I think so. Why is it in so many digits? Yeah. So now what I'll do, I'll change the format of this particular thing to percentage, which is this one, and this is going to main decimals. So I will keep 3 1. And then this only I'll copy format and I'll make this whole. So as you know, so this the benchmark return of 0.957%, which is nothing but 0. The actual answer is this one, the textbook answer, and this is our work. So they are exactly similar. So we have done it right way. I was using one extra bracket which was not required, because the two left and two right. Yeah. So now you know what is the benchmark portfolio return. So if you use 2.7% of General Motors, say 11.9 of Home Depot, and 2.56 and 9.8 of Triple M, M3M, so you will get a benchmark return of from 0.96 to 0.73. But what will be, we need to check once more that with what is, because if you have this benchmark return and if you have this benchmark proportion, then what is the benchmark return? So that also can be verified. So just put the cursor here and nothing doing, just do the matrix multiplication of this proportion, okay, and into this, and then you get the answer. So you got 0.01 because this is in fraction, not in percentage. If I use percentage, you'll get 1%. Okay. So this is what the thing is. Now I want to check whether this is like the optimal portfolio, which is General Motor HD is 2.7. Yeah.
Can you show that expected return of the benchmark formula again, what you have used?
This one. You're saying you meant to
Yes,
say?
sir. Yeah.
Yeah. So yeah, just see there, it is visible on the screen. So what I have done is I have multiplied
Not
this.
this one, sir, or the expected return of the benchmark, the 0.01, which you have calculated.
Okay. So I've just multiplied here. I've just multiplied this one with the proportion and the return. This proportion of the General Motor is 2.71 and its return 0.97. So they get multiplied and it's summed over here. So this is how it is done.
Okay, sir. Okay.
And because this is in fraction, so if I keep it percentage, it will be just 1%. So if I keep it percentage, so it will be 1%. So this is exactly what the textbook answer is. Okay. And so the same thing, like so supposing you are not given this benchmark proportion, but all other things are given. So you can also check whether the things you have calculated is right way. So what we will do here is, like, if you want to do it, so here we'll calculate Z. So for Z, as you know, how do we calculate Z? So we do matrix multiplication of matrix inverse, and then we have this as like the variance covariance, and then from here we take the portfolio return, which is ER, and minus constant is this 0.4%, and then we close this bracket. And so how many brackets? So 2 and 2. Yes. So now if I scroll enter, so I've got this value 5.76 to 40, 5.28, 5.44, 30.20. These are the proportion of portfolio Z. Remember, this is not normalized portfolio. This is just, so what I will do here, so here I will write equals this one divided by this sum and make a dollar sign here, because if I don't use dollar sign, I can't do it for all. So this is my 2.7 exactly, and then I drag it down across to the last. So I get 100% and exactly what the textbook answer of all these questions. Okay, so it means all our calculations are valid and they have been done in the right way. So why I do it, I could have done it just in one step by dividing this whole there in the formula itself, but I always recommend that first you calculate Z portfolio, which is the inverse of the various covariance matrix, and then multiply that by the expected return minus the risk-free rate, and then you are in a more methodical way of approaching the solution. Now we go to the part 2 of the Black Litterman portfolio optimization, where we are introducing our own opinion. Because if you remember the background I gave you about the Black Litterman approach. So Black Litterman, these two gentlemen, I will send you one file about their detailed background in 90s, how they came up with this, and now the whole industry just does this. Nothing more than most portfolio managers have talked. They do some variation of Black Litterman, and mostly Black Litterman in a very from light manner too. And in fact, some of them are not using at all because they are not comfortable using Black Litterman approach. The reason why Black Litterman approach some people are afraid of using is you need to be very sharp in understanding the forward looking direction of the market. So what happens is most managers lack that. They are not sure whether that going forward it's the IT sector that is going to do better, or it's the FMCG, or it's a pharma, or it's a technology, or it's some metal and mining, things like that. So then they what do? They basically do that same indexing and slightly tilting and all that. So anyway, so we are going to talk about the introducing opinion. So here what we are going to do is the same anticipated benchmark return, because this benchmark anyway, the anticipated 12%, because that is long-term average return of the benchmark. So what is happening here is the benchmark is same one, the treasury bill rate is same one, normalizing factor is same 2.12. So I have exactly copied whatever we saw and nothing else I've introduced extra.
So
This,
have you seen this file? From
I'm
like
sorry.
we have the old file in which you have already given this normalizing
Yeah.
factor.
This was shared with you on the last occasion only when I sent you. But in case you want, I can send you anyway. I will be sending it today, because today we'll be finishing Black Determined and we'll go to option pricing. But if it is not, then do let me know. Then I will share it right now only. The only my hitch is if it is there, then you can keep using that. Just open. I'm sure it is there. Uh, and anyway, because once I share, you will have the double solution. One is like the textbook answer, then how we do is also there. So just check. The last time the email was sent to all of you, and the file number today's practice workbook for today's exercise, and that is 12th March, not because the next one we didn't have, we could not finish it, and the next one was because of the Gudi Padwa. This was there was a holiday, so two session we have the same, almost we are using the same file. So just check. In case it's not there, I will share. So
Yes.
yeah, so same variance covariance matrix. If you remember 0.0118, 0.0031, 0.0021, and 0.014, and the same matrix. If you are like used to seeing this, so this is the same matrix. What we are going to do is the benchmark proportion is like this, but here in typical Black Litterman approach, if you are very sharp, you are genius, and you are very intelligent, if you are very hardworking and methodical, if you have done your work, and you realize that this is Hewlett-Packard, okay, and the proportion of Hewlett-Packard in the benchmark is 14.23, and the return of this, if I can take you this, so return of the Hewlett-Packard, which is the fourth one, is 1.36%. Now, if you have a feeling that the Hewlett-Packard 1.36 or the proportion is too low, chances that it will give you more, much more than 1.36%. Why? Because there are shortages of laptop or the desktop or the chip computers or the any other devices in which Hewlett Packard is there. Even the calculator chips are shortages. So the prices of those instruments will increase. There is going to be more demand, and so Hewlett Packard is likely to excel in the benchmark. So what I will do, I will increase its expected return, and I'll keep the expected return of all other benchmark in the same way, because this is at the very basic level of the Black Litterman approach. So that's what is happening. So now we come back to the here. So what is happening is this we have exactly copied from what we have done. So this I'm not, for example, Hewlett Packard is 1.36 is as you can see. The General Motors 0.96 as you can see. So this is exactly I have taken it from the previous calculation where we calculated the expected benchmark return, assuming that the benchmark had those proportions and the expected return of a Standard & Poor 500 is 1%, Treasury bill was 0.4%. What here we are going to do, or what the analyst is thinking, that the 0.96 which the General Motor was expected to deliver is a slightly understatement. So analyst has a feeling that this 0.96 is actually 1.10. It is not 0.96. So analyst is introducing one more factor which is called analyst opinion delta. Means analyst has a feeling that all other stocks are absolutely okay. And one more background to Black Litterman portfolio. So why Black Litterman portfolio became so popular in the portfolio management industry was because this normally, I will recommend you read one book called Trillions. This book, if you get a hang of this book, you should read, because this is like a Bible for exchange traded portfolio, ETF for portfolios and all that. So Trillions is a book where it is shown that anyone who claims that he's beating market is mostly lying or mostly like taking chance, because most portfolio managers fail to beat market, and that's what exactly happens. So here what this analyst is saying, that I absolutely agree with all the proportion of the benchmark, but this particular General Motor in the benchmark is low because he is expecting that there will be higher car sales in across globe, mostly in United States. And then that's why the monthly return will not be 0.96, it will be 0.14. And then he is rebasing all the adjusted return for all other portfolio, because if there is change in one expectation of the return of one stock in the benchmark, so all other stocks are going to be affected. This is very, very important. $1 million concept. If you don't get this, you'll never understand this. So this $1 million concept is, if by any chance even one stock is going to outperform the benchmark, rest all stocks will get affected. Why? Because variance covariance, this variance covariance matrix is nothing but the relationship of the return of one stock with the other, and because they are multiplied, so if one stock has higher return, the other stocks are going to. So as you can see here, this cell, this is once you have the analyst delta of 0.14, so the benchmark is going to get affected like this. So for example, 0.96 is becoming 1.1, 1.06, which has a zero delta, means we are not expecting any change in the next stock, which is the Home Depot. Or the 1.36 is Hewlett Packard. So there is no change in Hewlett Packard, but Hewlett Packard is actually going to be 1.41 just because of one change in this. So how this happens is what is the important thing to learn here. So what we are going to do is we are going to calculate here either one by r. Yeah.
We don't have this file actually. Can you send it? We have the old file.
You don't have the practice workbook for today's exercise?
No, sir, we don't have it. I actually checked the mail.
No, that's surprising, because I had done it and then sent it, because I was thinking that I would have finished this and then gone to anyway. So I'm sending it, but just one request, because for your sake, like this file contains like even these solutions. So don't look at the solutions. You try solving it the way I'm solving, otherwise you will not learn. So I'm sharing this only because I don't want to just delete all the solution and send it so that you work, because that will take a lot of time. So I'm sending it because, like, as you can see on the left hand side, this is the actual answer, but we'll calculate here and show how the actual answer comes. So so I'm sharing. So just give me 2 minutes. I'm minimizing this and sharing this.
Sir, one more thing.
Yeah.
So at the end of class, can you please send the completed file? Because what happens is, like, some of us miss out, and that is why we do not have completed file.
So this file is completed not from today, also from 4 5 days session back also. So this is like all encompassing. So this has
Okay, sir.
everything.
Okay, sir.
Just-
Thank you, sir.
yeah, this has formula also. This has everything which I have rough work also I've done in case I have any doubt. So I'm sending it and then we'll talk on this. Okay. So let me minimize this and go to the email. Just check. I've shared with you guys. So just check. If you receive and open it, then I will start. Hello. Hello.
Yes, sir.
You received the files?
So just let me check for
Yeah.
you.
Okay. Hello. Did you guys get this?
Sir, no, we didn't receive it. Can you send it on WhatsApp?
My God. Let me check this email. So wait, wait. So it was sent. Uh, today. Just a minute. Just a minute. Surprising. Yeah. Till uh, 9.
So could you please tell us which mail are you
Yeah, yeah.
sending to?
Yeah. No, no. So that's what like it looks like that there must be because I can't see it in my sent folder also. So practice work. I'm sending the something which carries other than that also. So you have little more this right and send. So now it has gone. Just check. I think there was some problem. I'm sorry. Like I think I tried sending from my personal email and probably that because both the emails are open, the college one as well as the personal one. So now I'm sure it must be just see check. So you haven't received yet.
We
Received
have
just
received,
now.
sir.
Received now. Okay. Okay. So we'll go and then do this because I was waiting you to. So you can open it and then can you see my Excel? You may not see this, so let me open the Excel. Yeah. So the Excel is open here. So it should be exactly here if like you are using my file. So we want you to be on 804, the row number 804. So what I'm going to do is 0.96 to 0.73 is the expected benchmark returns with no opinion because that is original benchmark. Sorry, the analyst just had 0.14 means because the analyst has a feeling that the General Motor is going to give you 1.10% return. But because, as I told you, because of the variance covariances, the return of all other stocks are going to change. And that's the only thing in this black letterman, that is what is you should be knowing, and you should be knowing by heart without any fail. And everywhere, if you claim that you know black letterman, then like you are expected to know. So what here you do, very simple. I'm going to do it for all 10. So just like pay attention and you'll know. So first is this benchmark return, that anyway we will use because we want benchmark return to be there. So we want. Now what we do extra is we go to this various covariance matrix, and because this is general motors return and we are going to calculate general motor, so we select this because that's a variance covariance of general motor, right? And we divide this by the same variance of the general motor, this one, and make a dollar sign here. I will tell you why we are doing this. So what happens as a part of our calculation, for every individual stock, we are going to calculate its benchmark return, and we are going to calculate what incremental return it's going to have because of general motor having a delta. So here what is happening is we have calculated, we have used the 0.96, which is its original return, and plus we have added the various covariance of general motor and divided it by the variance of general motor, okay, and made it dollar sign. Why? Because we want this thing to be constant across all. And then here finally, I think if I look right here, there will be error because Excel will understand that I'm dividing this. So I will change this slightly. Let me do this this way. So I use this delta here first, okay, and then multiply delta with the same thing, this variance covariance, divide by the same variance because this is going to be the constant across one. And then C804, this also is going to be constant across because this incremental return is what is same across all. And if I press enter, it gives me 1.10. So it means my formula is fine. But this anyway you knew it. Why? Because you had 0.96 this return, 0.14. But as you can see, 1.05 is the return of Home Depot, but the actual return should be different by this formula. So how that should be, we'll know. So we'll calculate, we'll add this 1.05 plus we'll take this opinion, which is the return of General Motor, which is over and above the benchmark return. Here we'll multiply the variance covariance of Home Depot. Okay. The variance covariance of Home Depot we are multiplying, and then we divide this by the same variance covariance matrix of the General Motor because this we want that to be constant. So we divide that by this, and if I press enter, I get 1.08%. So as you know, while the original return was 1.05, the actual return has changed to 1.08. And this is the magic, which is what Black Letterman compels you to think differently. Why? Because just one stock, you had a feeling that General Motor is going to give you not 0.96, which is what its long-term average return is, but slightly more. But because of this, the whole thing is going to change. So now, if I keep doing this, so for example, if I do this, so this will be this plus this delta return into the various covariance matrix of the I paper, and I divide this by the variance of this, and if I press enter, I get 0.80, which is what the return of HIP is going to be. If I want the, what about Hewlett Packard? So 1.36 plus this delta 0.14, which is the incremental return, and here I take this, the Hewlett Packard variance covariance with General Motor. Just remember, I am using only this first column of this matrix. Why? Because I want variance covariance in relation to the General Motor, and then divide this by the variance of General Motor, and I am done. So I am getting all the answers. So I leave it rest of the table for you to finish, because anyway, you know, on that left side it is done. But if you want to do, you try this over here and you get answer for I could have done all this in one step by like writing the sum command, like by writing the column command, where I would have written this like straightway from here to here, and I would have added this, I would have added this, and then divided by this one factor, and I would have got this. So I leave it for you as an exercise that you try these 6 leftover cells to finish. But I want another thing, and that is, see, the benchmark portfolio return is given to you as 2.71 to 9.81. So these are all the benchmark portfolio. If you sum them up, they become 100%. So it means our benchmark originally was General Motor 2.71, Home Depot 11.91, iPaper 2.56, Hewlett Packard 14.23 to Triple M or M3 9.84. Now that having realized that your returns have changed to this because of just one great player changing the whole dynamics of interplay between various stocks, what will be the benchmark portfolio return? Because you have the change return. So here, as you know, here what we are going to calculate is the same Z matrix, which is what? So this can be done in two steps also, but I will try to finish it in one step so that we save time and go to something important. So what I'm going to do is select this entire array, and I'm going to write here equals. So my formula is ready. Now, as you know, if I want to know the actual proportion of this portfolio, so basically I'm doing nothing but a standardized Z I'm calculating. So what do we do in this Z calculation is we multiply matrix inverse. So inverse, and in matrix inverse we take the whole variance covariance matrix. So I take the whole variance covariance matrix. Okay, and I close this bracket because first it will calculate matrix inverse, then only we want to know the result. And then how do you want to multiply? So you multiply matrix inverse with ER minus C, which is expected return. So what is the expected return? So your expected return is now this, which is already done here. Okay, so your expected return is this, and from here I will subtract the constant C, which is nothing but the treasury bill rate. Okay, so now this is done. If I do like this, it will only give you the Z matrix. So I therefore I do the sum command so that it sums across all the values, and then after the sum I write the matrix multiplication symbol, then I do the matrix inverse, and I select the same variance covariance matrix, which is important. Then I close this bracket because first operation will be variance covariance, that inverse of variance covariance. Then I need the benchmark return or adjusted for opinion. So this is this. And then from here I need to subtract the risk-free return, which is 0.40. Then I close this. Now the important thing that is going to be in action here is how many brackets I need to close. So just let me count from here, because one more factor came. So I need 1, 2, 3. 1, 2, and 3. So this is done. And the first one also is done. Done. Yeah. So hopefully we are done with this. So if I control shift and enter, I will get the whole. Yeah. So just see the magic. Whereas the actual one was 2.71, the real one now is 7.85%. So what I will have to do, if my research analyst tells me that look, if I'm a portfolio manager and my analyst tells me that look, the General Motor is going to outperform benchmark by 0.14%, then just because of this, I will have a completely different portfolio than what I had before. So for example, you can see General Motor has gone from 2.71 to 7.85, so almost 4 times more. Almost similar, this is stock called Home Depot. IP is almost similar, but slightly more in case of Hewlett Packard, because Hewlett Packard gets higher correlation with or higher covariance with GM, and that's why it's getting higher return. And then this one, the MO and American Express also higher return, and somewhat higher return is this AA, and this DuPont is like little higher, and then slightly higher is MRK, and triple M is slightly higher. So all other stocks got readjusted. Some got little more, some got little less. So that's how like we had to adjust everything just because one particular stock was going to outperform. So this, in brief, or in the shortest way of putting it, is the black letterman approach, how a portfolio manager does it in his home, like in his office. And you know, the magic of this formula and magic of this modeling is, if for somehow, if I am told, someone tells me that, look, there is sanction on a certain auto company, for example, Volkswagen has been penalized by $2 billion because it cheated on emission standard in Europe and in America, and Volkswagen cars are not going to be sold much. So the moment I get to know this news, I'm going to adjust this by 0.28, and my everything changes tremendously. You know why? Because of 0.28, everything else changes here drastically. And what was 2.71 has become 12.48. Something got reduced here also. So like that. So once you have this black letterman done at your desk, so forever it is done. So this in a very simple way. So if an analyst has simple opinion about one stock, this is how it is done. If I have opinion about the second stock like Home Depot also, that also I can do, which is what I'm going to explain to you. But normally in a very basic way, one or two stocks only where the portfolio managers have issue. However, if they have issue in all the stocks, for example, if the portfolio manager believes that all these returns implied by the benchmark proportion of 2.71, 11.91, or 2.56, 14.23, 24.69, in this proportion, if you keep, is actually going to be nonsense. Why? Because all stocks are going to be outperforming. They are going to have higher return because markets are going to be upswing. There's no COVID virus. The impact of the virus is muted, and the Ukraine war is good. Is going to be negotiation between Russia and Ukraine and the NATO and all that. So things are going to be much better. So it's possible that then I readjust everything else, and then I change it, I tweak it further. So how do we do that? We are going to see that variation. So see, if you have if you really know that all the individual stocks in the benchmark are going to be outperforming or underperforming, then in that case you need to calculate the tracking metrics, which is what is important. So what you need to do is to calculate tracking metrics. Then only you will be in a better position to calculate all these returns when the returns of all the delta of all the stocks are varying. If all these were not zero, and if they were 1, 2.30, 0.45, etc., etc., then this simple formula would not have worked. You would need a little more sophisticated formula, because then there will be correlation of one to other, and then because covariances are not one with one, it is one with another 9 1, and because all of them are changing, so it's not possible that just because you're using General Motors formula and you are applying across the all Hewlett Packard or the Triple M or DuPont or American Express and so on and so forth. So what we need is something called a tracking metrics. So how do we calculate tracking metrics? So let me remove this, because should I remove this, or should I do it at a different place? Yeah, it is already done here. So let me remove this and then do it here. So delete. So you see the tracking metrics is calculated, but how do we do tracking metrics? So tracking metrics, we actually divide the individual variance covariance by the matrix of that by the variance of that particular stock. So for example, in this particular column, we'll divide this column by the variance of general Motors, and then we'll see the value. In this particular case, we'll see the variance covariance getting divided by the variance of Home Depot. In the third, we'll get the whole variance covariance divided by the variance of IP, and so on and so forth. So this is how we do this. So let's do this. So how we do this? So let's see how we are actually going to do in this. Where are we? Yeah, so we are here. So I have selected this entire yeah. So just a minute. It has to be done manually. So our original various covariance is this one. Yeah. So this one is this one. Okay. So this one is starting from 791 to 791 C1. Okay. So I take the first one. So then this become 1 into 10. Sorry. 1 into 2. So the first 10 I selected. And I write here equals this entire one divided by the variance of General Motors. So entire variance covariances of all the individual ones are getting divided by the variance of General Motors, and I click here. Okay, so I get the first row of the answer, which is, as you can see, I got the variance covariance of matrix, which is what we call a tracking matrix for this one. So accordingly, I will do for the second one. So in case of second one, again, I will select this. It can be done in one step, but I am showing you how it is done individually. So again, I go there, over there, here, and select this entire one. Okay, the second row, and divide this by the variance covariance of this one. Remember, I'm going to do this one, HD to HD, not HD to GM, because in this case, I'm going to multiply all the variance covariances of the second row by the variance of HD, Home Depot. So see my answer. So my answer is exactly matching on the left hand side. So this is our tracking matrix. So in tracking matrix, you will always find the diagonal ones as 1 because they are getting divided by the variance covariance is getting divided by its own variance. The variance of the particular stock, General Motor by General Motor, Home Depot by Home Depot, and like that. So you'll keep getting this. So all this 10 could have been done at one go. How? So I would have just used the dollar command and done it. But I will show you a better way of doing this. So let me show you how the better, like it can be done in one step and without disturbing anything as such. So I have even better way of doing this. So I delete it. And the file that I have shared with you is macro enabled. So tracking. So BL tracking is the for this one, BL tracking. And I select the entire variance covariance matrix. This one. Okay. And I close this bracket and Control Shift Enter and see my entire value has changed. Why did it? See, we are getting some value like this NA. You know why? Because while selecting, I forgot to select the entire one. So let me remove them and once again select them. So I get the value. So this is okay. No, 10 into 10 I want. So 2, 3, 4, 5, 6, 9, 10. So I got 10 into 10. Here I write equals DL T RACKING. And then here I select the entire variance covariance matrix. If I by any chance miss something, because I may not see everything, so my formula will. So I come back here in my tracking matrix. Yeah. And then I use Control Shift and Enter. So I've got the value for all. This is your tracking matrix for variance covariance, original variance covariance. So as you can see, the individual one, the next one is 1, The next diagonal is 1, etc. Because they are getting divided by their own variance. So these are actually the variance, and they're getting divided by. These are actually the variance covariance divided by variance. These are variance covariance divided by variance, and that's how things are changing. So as you can see, this is different from the original one. Now, you might ask the question, why did I do this? The variance covariance, the tracking matrix of the variance. The answer is this one. So on this side, if you can see that what I have selected is, if GM, I'm going to calculate the return of General Motor, opinion adjusted, where the return of General Motor is given, the variance of General Motor is given, but also the delta of not only General Motor is given, delta of Home Depot, delta of IP, and delta of everything is given. So the formula changes like this. Similar way, if I'm going to calculate HD, so I'm going to calculate HD, then the return of HD, which is what we did previously. But in previous case, if you remember, there was nothing like delta HD. They were all 0. So there was no need to use all these formulas. So what we were doing is basically we were calculating this one. So now that you have this tracking matrix, what formula you use? So if you have tracking matrix, you just multiply that tracking matrix with the proportion and you get the actual return, which is what. So I will show you that also. So I think that is not shown here. Let me check. If it is not shown, then I will. Yeah, it is here. Sorry, I kept it too far and too far. That's why even. So this is the formula for everything that you would ever need to know about black letterman. So in case you want to calculate return for all General Motor, Home Depot, Triple M, so you should have this tracking matrix, which is like you can say diagonally all 1, and this is divided by the variance of General Motor, which is what we did, and then deltas here. So variance covariance, and then the transpose of this delta. Or like if the delta is in column, there is no need to make transpose, and then you have everything. So this is one-step solution for all your black letterman portfolio optimization. But then you need the BL tracking matrix, and because I've already enabled it macro, so if you can keep this file in the examination, if I give you a different variance covariance, if in examination I give you change this variance covariance, let's say if I change this, all you need to do is just like select this, write BL tracking, and just take your cursor across all these things, you get the answer. So in fact, this is the easiest way of solving a problem than actually doing all other things like this, which is what I did. This is 0.28, but if I make it 0.14, so then all individual get changes, and then if I keep changing, so individually I'll have to adjust. So compared to place where you do it for 1, which is very easy to do, if you have the opinion for all the stocks, then you do BL tracking, or like you calculate tracking metrics, and then your final answer is this one. So you should have a matrix like this, where all the returns will be the variance covariance tracking matrix multiplied by the deltas. So all the deltas will be here, which is what I showed you here. So this is just one delta. So let's say if I change the delta to 0.23, 0.24, 0.11, and like that. If I keep doing this, so then this formula will not work. This formula will still work, but this will be just an approximation. Why? Because you have factored only GM's return, but you have not factored this. For that also we need to add one extra, and then keep adding that. Well, for this factor also we need to make provision for this factor, because all other things are changing. So this is not possible in this simple black determinant, and that's why we do it by this formula. So just remember this formula, and we'll solve everything. If you remember this, the last formula, this one, this is most important for black determinant. So if you have BL matrix, and if you have deltas, means opinion, where analyst opinion is changing from the benchmark, is what delta is, so you get the return. So that's it. One last thing then about black letterman is where we are going now. The last thing about black letterman before we move to option pricing. So now you know that the portfolio manager of foreign institutional investors, or some of the large mutual funds like BlackRock, or Fidelity, or the Credit Suisse, all these, they no longer invest in just one market. Means they no longer confine themselves to US market. What they also do is they invest across multiple jurisdiction, globe, continents, markets, sub-markets, and the type of instruments and all that. So what we are going to do is we are going to see black letterman for international asset allocation, where we have 5 different benchmarks. So what are these 5 different benchmarks? So these 5 benchmarks are S&P 500, Morgan Stanley Capital International World X USU Equity. Russell 2000 is the a small cap of the Russell 3000 universe, which contains all the 3000 stocks listed in USA. MSCI Emerging Market Index, where India, China, Korea, Taiwan, and all these big markets of like Malaysia, Singapore, all those. I think Singapore will be developed. So emerging will be Malaysia, and Sri Lanka, and all other markets will be there. And then LB Global Aggregate is Lehman Brothers. This is a bond market index. So we have these 5 indexes. So we have these 5 indexes on which we are going to use black letterman to know if we use these indexes in the proportion in which their weights are. So the weight is also given because you know the weight in the global portfolio. So the weight of S&P 500 is 24%, MSCI is 26%, 3% is Russell 2000, 3% is MSCI Emerging Market, and LV Global Lehman Brothers weight is 44%. Some of you might ask that why, though its return may not be high, but why is it that we are using bond index so high? The answer will be that most managers they also want to ensure that at least some return their portfolio is returning, so they want the fixed income portfolio slightly higher, and which is why you can see that in this international benchmark we have in this proportion. So we have 100% of the portfolio invested across this 5. What this data you are seeing, what I have selected, is not the variance covariance matrix. This data is basically the correlation matrix of all these international portfolios. So how this works is, from here you will need to calculate variance covariance from this particular matrix. So how do you do variance covariance from just a correlation and a standard deviation? And this is again, like, if you remember, the first thing I began with and first thing I discussed in the class was the calculation of variance covariance matrix. But what I didn't discuss was what I'm doing here, because I knew that at some point of time we would be doing the other way, which is a correlation method. So here what is happening in this particular case, you are just given correlation of S&P 500 with itself, which is 1, with MSCI 0.88, with Russell 2000 0.84, with MSCI Emerging 0.81, but minus 0.16 with Lehman Brothers Global Aggregate Bond Fund Index. So because it's a negative correlation with the Lehman Brothers, so this is where there are tricks issue involved. Now, because these are all correlation and we want variance covariance. Why? Because without variance covariance, you will never get to understand that what is the return of the portfolio comprising of 24% in S&P 500, 26% MSCI, and 3% and 3% in the Russell and Emerging Market and LB Global Aggregate. As you can see, the correlation is very high, which is again like a problematic, because if you see high correlation, what it speaks for is a badly diversified portfolio. Because in a portfolio, except this Lehman index, all other benchmarks are highly correlated, which gives you a sense that all markets are highly following each other, and that's a major problem when you invest across in good markets. So anyway, that's not a concern for us. So these are the correlation, and this is the weight, and this is the standard deviation. Now the million-dollar question is, how do you get variance covariance when you are just given the standard deviation and the correlation? The answer is, if I multiply my standard deviation with its transpose and with the correlation, I get the variance covariance. Why? Because, for example, let's see. So if I do this into this, so I get 0.0222. So this becomes its variance of the S&P 500 because this is just a standard deviation square. However, if I multiply this and multiply this, sorry, the first one, yeah. So I get variance covariance of MSCI and S&P 500. So like this, I can go on and on and on and on. Like so, I will have the individual one. But as you know, in variance covariance matrices, like there are identical matrices because the so matrix RJI equals matrix RIJ because they are positioned like that. So how do we calculate this? So to calculate the variance covariance matrix, all you need is very simple thing. And that very simple thing is like you multiply the transpose of this the standard deviation with itself and then with the correlation and you get that. So let me show you how it is done. So I select how many these are 5 and what I want is a variance covariance, so I need 5 into 5. So I select 5 into 5. So I have selected exactly 5 into 5. And here I do simple, I don't do matrix multiplication. I do simple multiplication of, so so first I should take this or I should take that. So let me try first this way. So this is 5 into 1. So if I multiply 5 into 1 with 1 into 5, it will 5 into 5. So I do this and multiply this with yeah. Anything you want? Anything? You can talk. No problem. Yeah. So I will be done in some 20 minutes. No, I will manage for you. Just wait. Okay. So I multiplied this with its transpose. And then that I multiply with these correlations, all correlations. And I think I am done. Yes, I'm done. So I got the variance covariance matrix. Did you guys understand how it is done? Can you do it? Where, like if you are given this? Hello?
Yes, sir.
Yeah.
We understood the
Yeah.
matrix part.
Yeah. So variance covariance matrix, when you are only given a standard deviation and correlation, unlike all other places, because in other cases, you invariably you are being given the return. So from return, it's very easy to calculate variance covariance because you just from the return you subtract the excess return and then you multiply the original matrix with its transpose and you get the variance covariance. That is the standard variance covariance matrix. And then we saw the other approaches like single index model, where like I shared with you. So this is done. So this is exactly what I have replicated. What this is there is already here. What this is here is already we calculated. So we have done for everything. So now we come back to here where we have the variance covariance of all these 5 international benchmark, their weight, and their weight sum to this. Now we want to know what that by doing this way, what is the return of this international benchmark? What is the implied return of the international benchmark? Because you are only given the weight, you are not given the benchmark return, right? Because you are given the weight and you are given the variance covariance matrix. So here what happens, we make some assumptions and that is this way. The S&P 500 return is 12%, which is what we took always. So we have always been taking the S&P 500 return as the 12%, okay, and the risk-free rate as 5% is what is given to you. So these two things are given to you, and because this is readily available. Why? Because risk-free rate is like you can invest in treasury bill and you can get to see what the risk-free rate is. always, all the time. Yesterday also RBI it left the status quo, but you know what is the repo rate, reverse repo rate, and the bank rates and all that. So this risk rate is, so these two things are given to you, and then what we want to calculate is what is black litterman employed portfolio return. So we do 4-step calculation, and then we calculate the what is the implied return, because this cannot be done. This can be done in one step, but I don't want to bombard with you with a formula which we have till now not used it, because if you use this, I will have to tell you why we are using it. So I want to make it simple, and then later on I will share with you the formula. So as you know, for implied return, so if I have to calculate, so I use this one. So 1, 2, 3, 4, 5. So for implied return, what you do usually for a benchmark, you do matrix multiplication first, right? You do matrix multiplication, and matrix sorry, I calculated double one of this variance covariance, which is invariably the case. Okay, and you multiply with what? The proportion, because sorry, you don't multiply with the proportion. So what you multiply with? You have the variance covariance and the so what you multiply with their weight. Weight, actually weight is the another thing. Or yeah. So because unless you multiply the weight, you don't get that. So yeah. So you multiply with that the weight. Okay. So this is how you do this first step, and then here we multiply, which is what we read in formula in the if you remember, I shared with you the TPT where I showed you that ultimately we need to multiply this by ER minus C. What is our ER? Is expected return on the benchmark, which is this 12% minus this 5%, because constant is 5%. And then I close this and use. So I got these 5 returns. So let me make first this into percentage. So I got this in percentage. Okay. Now what I do here, now the second column that I'm going to do is there is slight involvement here. So this was easier. You just multiplied the variance covariance with the weight, and then from that you multiplied the ER minus C, which is the return of the benchmark minus the risk-free rate. In the second one, if you remember the original Black Litterman approach, so in original one, if you remember, we were dividing all other deltas, like all other individual variance covariances, by the variance of general motor, because we are assuming that the general motor only is changing its delta by 0.16, 0.96 and 0.14. Yeah, so 0. By 1.14 it was changing. All other were constant. So what we were doing, we were dividing by the variance of general motor, rest all, and their covariances, and multiplying by the delta. Same concept here we apply. The difference here is we use the first row and first column of this multiplication. So if I multiply this row, this variance covariance with this one, I get first row and first column, which will nothing but this one only, which will nothing but this one. So exactly, so like if you see here, for example, just see here. So these, what I have done here in this case is I have multiplied the various covariance with the weight factors. Okay, I have multiplied the various covariance by the weight factor. So the same thing if I copy it here, just like to save time, I'm copying that here and bringing it here. Sorry, bringing it here. So this is okay. Now in the third one, what I have to do is I have to divide this by this. But I have to divide all by this only. So let me make a dollar sign. So this is done. So this is 7%. And if I drag it down, so I get for everything, everybody. Okay. So I've got the return for all individual components like S&P 500, MSCI, Russell, MSCI Emerging Market, and Lehman Brothers Gold. Here, what I will do in the next column is I will add the risk-free rate because that is one of the ways in which we adjust the return. So 7% and plus the risk-free rate return is this one. I'll use dollar sign because I want to do it for, sorry, I got mistake. So this one plus this one and I make a dollar sign and I calculate it. So then this becomes this. So this is the implied portfolio return of the the international implied portfolio international benchmark. So this is your final answer. Now, this whole thing can be done in one step, which is what here is done. Here is done. So if you can learn this, great. So, but I don't want to tell you about the index command, which does look into particular row and particular column, which is what I did it in 4 steps. But that's okay. It's just try understanding how it is done, and then you will know like what this does in 4 steps, this does in 1 step, and then you are done with this. So with this, I will just save it and again share this file with you so that this you can use later on. Then we go and understand something about binomial option pricing model. So let me close this and let me reshare. So can you see something on the screen? Can you see something on the screen being shared with you? Hello?
Yes, sir.
Yeah. Okay. So tell me one thing, because what happens is option is slightly more involved than the simple portfolio optimization, which is what we have been seeing till now. Because in portfolio optimization, what we were doing is like a programmer job. We knew that this is how the formula works and we were doing it. But in option, that's not going to be the case. Why? Because you require a great amount of theoretical underpinnings before you solve any call option, put option, American option, European option, binomial or Black-Scholes. So at all other places, you need concept about this. So I assume that you don't know about it, and then I begin, because even if some of you know it, because still there will be large number of you, because most of you are economists, and economists mostly understand that what is the macro economic trends are going to be, what is micro trends are going to be, and how is the economy going to function, how is the economy going to fare, and how is the interest rate going to be there, inflation, employment, and so on and so forth. So when it comes to finance, like some of you may not be as sophisticated as is the case. So let's see this. So just look at this lattice. So here you can see the stock is at S today. So stock price today at S, which is what is the starting point of binomial day 0 in binomial model. Why are calling it binomial model is because in this model there are only 2 possibilities. One is with either the stock can go up or the stock can go down. If the stock goes up, it will be priced at a higher than its current value, because obviously it's going to give you higher return. If the stock goes down, it is going to give you lower value than the stock at which it started, like S was the price. Now, when the stock goes up, definitely it has a value more than the stock when it was beginning. But if the stock goes down, it has less value than the stock when at point 0. So we'll call this node at 0 time, and this we'll call at time 1. And in time 1, there are two possibilities: either it goes up or it goes down. If a stock goes up, so S plus is positive. So then what is the value of call? So C plus, because stock goes S plus, so C plus will be maximum of 0, S plus minus X. X is nothing but exercise price. So okay, so let me introduce you certain things here. So capital. So S is stock price, so that you know it. Otherwise, like, it's all going to be a little complicated from here. Exercise price. Okay. And then small c, call option price, and small p, put option price. So this is what we are going to see. If the stock goes S plus, so C plus will be maximum of 0 to either 0 or S plus minus X. Why? Because we, as you know, so for example, let me explain, because this first day I need to explain. So if a stock exercise is 50 and a stock goes to 60, so 60 minus 50, 60 minus 50, it is 10. So 10 is going to be the maximum value of the call option price in the positive note. But in the negative note, so let's say if the stock goes to 40, so there will be minus 10. So as I told you that there cannot be anything like minus. So what if I write like this, maximum 0 stock minus exercise, sorry, stock minus exercise, then get a value of 0, because it cannot take the negative. Now if I change to 60, it will give me a value of 10. So this is how we calculate the S plus and S minus. So this is how the basic, at a very, very basic level of binomial model, where there are two possibilities: stock can either go up and go down. If go down, the value will be C minus. If it goes up, the value will be C plus. But what will be the call price today, which is C, is call price today. P is call price today. So P is put option price today. So this is what we'll calculate, because this we can easily get by knowing that what a stock is going to go up and go down. So here is a catch, and then I begin by telling you that. So there are certain assumptions that we need to make about the binomial model, and these assumptions are variable in the sense that all assumptions can be varied up and down depending on what your thinking is, but they are going to be the same exercises across all exercises. So once you know assumption in a particular case, the same assumptions you can tweak and then apply. So I will just tell you what are the assumptions I'm going to make. So what I'm going to make an assumption is the stock is going up by 10%. So this 1.1 is the 10% of 1. So if a stock goes, so stock here I assume that is priced at $1. If at all it is priced at $1, so S plus will be 1.1. If it goes down, it will be 3% down. So this will be 97% of the original value, so 0.97%. Initial stock is 50 rupees. Risk-free rate is 6%. So R is nothing but R is what? So if risk-free rate is 6%, so R is nothing but equals 1 plus 6% is what I have calculated. Sorry, it's 100%. So this is equals 0.01 plus 6%. So there is some problem with this.
Sir,
Just
Sir, it should be 1 plus 0.06.
yeah. No, I know, because the Excel has some issue. It has started giving. Otherwise, I could have done whatever.
It was actually giving answer in percentages.
Yeah. So
You would
just
have
ignore this.
converted number.
Yeah. So ignore it. This is very basic, so no need to worry about this. So interest rate 1 plus R is what I have used here, and this is exercise price. So I'm assuming that the stock price and exercise price are the same for the moment. So here in this simple case, I'm going to use this. Now, at a very basic level, I'm going to replicate an option pricing model on the basis of something called arbitrage. So what this arbitrage is, I'm going to buy A number of a stock and B number of bond. Why? Because even whether market goes up or goes down, the bond will always give you return, because the 6% rate of return is there. The bond will always give you 1.06 and 1.06 whether market goes up or market. So if the bond price is 1 today, it will give you 1.06 in up position and 1.06 in down position. However, the stock will only give me 55, which is up, because the 55 will be multiplied. How I get 55 is, I just here do it is 50 into 1.1. So I get 55. How I get 48 is I write 50 and multiply this 0.97, because I take the down situation. So I have assumed two things. What I have assumed is the stock goes up by a factor of 10%, goes down by a factor of 3%. So it becomes 0.97%. But in case of bond, you cannot have the difference, different value, because whether you market goes up or down, bond will always return is 6%, which is 1 plus 0.06. Okay. So with this assumption, I create a hypothetical portfolio where what I'm going to do is I'm going to buy a stock A, capital A. So this is my stock and this is my bond B. On B.
So can you also send this file so that we can practice side by side?
I'm sorry.
Can you please send this file also? We'll also practice with you now.
Yeah. So just hold on. So, but it contains a lot of things. Again, like it's so like you take it, but this wait. So first I will send this. So yeah. So I'm sending you the macro file only, which is and then this is sent. So this is sent. Just check this and you can okay. So can you see my Excel? Are you at my Excel?
Yes, so your Excel is visible.
Okay. So if I have bought a stock of A number of stocks and B bond. So if the stock price goes up, my situation will 55A plus 1.06B after period 1. Why? Because in period, if I have A stocks, so the price will be 55A and 1.06B. If the stock goes down, so it will be 45.5A and plus 1.06B. So this portfolio should actually replicate the call option, the portfolio, which is what I showed you here. So so if I make it 55, so 5, and if I make it 48.5, so it's 0. So like that, it's giving you value. So this call option value will always keep fluctuating depending on where the stock price is. So what I have done is I've replicated a portfolio where if the stock goes up, so my value will be 55A plus 1.06B. Why? Because my one bond B will return me 1.06B times the money. And the A number of stocks will give me 55A. Why? Because one stock is going to be from 50 to 55. So my A stock will become 55A. So 55A plus 1.06B should be equal to 1. Why? Because this is how where the price is. This is where the price is. Because if the stock was 55 and exercise price is 50, which is what we are assuming, that 50 and it goes 55, and we replicate by this arbitrage that we buy A bond and buy A stocks and B bond. So our situation is 55A plus B, which should result into the same 5. If by any chance the stock goes down, so this becomes 48.5. This value becomes 0. So exactly the second situation, 48.5A is the price that is the price of your A stocks, and the bond will again give you the same value, 1.06B, but here this should be equal to 0. Why? Because your lattice, this is returning you 0, as you can see here. With when the stock going down to 48.5, exercise remaining the same, your call value is going to be 0. So these are the two equations we are going to use. 55A plus 1.06B equals 5. 48.5A plus 1.06B equals 0. Now, as you can see, this is a class 5th or 6th, I think class 5th math only. This is class 5th math where like the second part of the equation is the same. So if I subtract one from the other, I get the value of A. So A is nothing, 5 divided by 55 over 48.5, which is what I have used here. Okay. So if you do exactly like this, so if you do exactly like this, so equals 5 divided by 55 minus 48.5. So to change this to 5, then what? And make it 5. It becomes the value of A. And if I have the value of A, okay, so what is the value of B? So B equals 0.48.5A upon 1.06. So B also I can calculate like this. So minus 48.5 into this one, this is A, divided by 1.06. So I got minus 35.19. So the answer to your question is, we need 0.77. So for example, why I'm saying 0.77 is, I just approximate. So I need 0.77 of stock A and minus 35 of bond B. So basically I need to borrow 35 of bond B and invest in 0.77 of the stock A, and then I'm done with this portfolio where if the market goes up or market goes down, my portfolio is giving me exactly the return that is required. Now the question is what is the value of the call? Because we have not calculated what is the value of call, which is C. C is what? You calculated A, you calculated B, but what is the value of C? So the value of C is, as you remember, we'll buy bond A. So bond A will have a value. Sorry, the value of bond A will be 0.77, and the price was 50. This will be this, and value of B is 35 point this one. So from here, we'll add the value of bond B also. And then we got the value of the call option. So this is the pricing of the call option. So your call option will be priced at 3.265602. So this also can be formatted in a similar way. So if I format it here, so I get 3.27. So $3.27 or rupee, depending on which currency you are trading, is the price of the call option. Now, the next question that you should bear in mind or remember in mind is this is how you are going to do in Excel. The answer is a big no. This was not at all required to be done. But why I wanted you to understand that this is the mind behind Excel doing all this calculation. hereinafter we'll just use the state formula. We'll do a state and slightly at advanced level we'll use the VBA programming, and we'll use the macros, and they will just do calculate in one command, and then you have all the binomial option pricing done in one step. Nothing else is required. All you need is the initial stock price, exercise price, the up value, the down value. That's it, and the interest rate. Of course, interest rates are required to discount it back to the normal. So then this is how it is done. Now, there's one more thing that you might be asking, that I talked a lot about the call up. What about the put option pricing? How do you calculate this? So the answer is very, very simple. If you know the call option pricing, you can use something called put call parity and you get the answer. So I do that way. So I will recommend, but it can be done the other way around also. So for example, there is a value for C plus, there is value for P plus also, and there is a value for P minus also. So we will have the P plus, P minus, and finally with P plus and P minus we can got this. We can get this P, which I will show you. But the best way to do this P once you have C is use this formula called C plus X discounted by 1 plus R minus stock. And if you use this formula, you get the value of call. How many of you know put call parity? Does anyone know about put call parity? Hello, guys. Let me.
Yes, so we know the equation of put call parity.
Areva, great. Then I am just wasting your time by just talking about this. So then I will stop here. I will not talk about, because I thought some of you might not remember. Okay. So great. So then this 50 goes to 55 and 48.5. 1 becomes 1.06 irrespective of the direction. And this is how these two formulas are calculated. And then call price is calculated. Now, just I want to show you the same for put option, that how we do in case of a put option. So in case of put option, just remember this 55A plus 1.06B should give you zero value. Why? Because put will have a zero value if a stock goes up, because put options exercise once a stock goes down, not when a stock goes up. So 55A plus 1.06 should give you zero value, whereas 48.5A and plus 1.06B should give you 1.5. If you solve these two equations together, you get A as 0.23 and B as 11.97. And as I told you, if you get value of A and B, all you need to look into what is the starting price. So basically, your starting price is equals 50 multiplied by A. Actually, this A value seems to be wrong because I'm going to get the wrong, but still I will calculate this, and plus this. So this, the value of the put option 23, which is the worst calculation any human being will do in case of binomial method. Why? Because when stock prices are 50, put prices cannot be half of that. So as I told you, this answer is wrong. Actually, this is negative. Actually, this is negative, which is wrongly done. So I just put a negative marks on this for the moment, because I know that this is wrong. So once I correct that, oh, why I got both of them negative. So I think here it got wrong. So here I will make it positive. So yeah. Oh, let me delete everything. So so this becomes 1.5 divided by 48.5 minus 55, not the other way. That's why this formula was wrong. So this is this, and then B is, and how much is the B? So B is 55A upon 1.6. So 0.58 upon 1 point. Yes. So now coming back to the calculation of the put of so equals 50 into this one plus this bond. So why is this formula getting wrong? So this actually this is wrong. This is positive. B is positive. So why is B? Oh, yeah, silly mistake. Anyway, so if I make this positive because the 1.5 will become negative, it comes on this side. For a moment, let me make it minus. So you got the exact put of value of 0.43514. We see exactly what it is done here already. It's done here with the same prices here. So call option, put option prices are done here, and you got a put option price of this. So this is how we do call put pricing simple binomial model. So on next day we start with QE, QD, and all these things. So even if you look at it, you will not understand because this is how we are going to do with advanced Excel modeling of the up price, down price, and these up factors and down factors and all that. And we go and see that 5 tree, 6 tree, and like multiple tree. We can do have 10 tree and 100 tree also. So I will use this VBA and we can program it faster. This is how we are going to do. I've shared with you. If you want to look it, you can get prepared in advance, and then we'll see how we approach it later on. So, okay. So you have a class from 11:30, right?
Yes, sir.
Yeah. So I will stop here and then see you. And also, like if I receive your marks, I have only so this. There is a guy. The name I told you in the beginning. So I could see the paper of only one guy, and his name is Kirti Marwa. Is he around?
She's
Kirti
not in
Marwa
the
is
class.
around. Okay.
No,
So
she's
like
not in the
anyway, so
class.
like that. She is not in the class. So Kirti got I think 17 marks out of 20 because one of the problem she goofed up. So I had to cut 3 marks for that. But rest all 3 questions were done excellent. I will see for others and then maybe in a day or two I will send the answers for all those. So all the best and okay, see you on the next day.